Hi everyone. Today we are diving into something that might sound boring at first, investing in the Chinese stock market. Stick around, I promise it's more interesting than it seems, especially if you're really thinking about whether to buy any products in this particular stock market. Let's kick things off by talking about how the Chinese market isn't your typical buy low, sell high affair compared to the US, where you might grab an index ETF or some Apple shares and chill. Chinese market is a bit like navigating a maze, blindfolded with a twisty straw in hand. The Chinese market bigger isn't always better. So, the Chinese stock market is the second largest in the world, right after the US. You'd think that title it will be booming, like how you hear about China's economy growth or the technological development. But guess what? The market and economy are like the odd couple you see at the mall. One's racing ahead and the other's lagging behind, trying to catch up. From 2010 to 2023, China's GDP tripled. That's equivalent to 8% per year, but the Shanghai Composite Index, it dropped by 10%. Yikes. Meanwhile, the US GDP was cruising along at about 5% per year, but the Nasdaq was up more than 6 times. Well, as you can see, the economy's growth and stock performance do not hold hands as tightly as you think. Stocks don't always reflect the economy. You think a country's booming economy would equal skyrocketing stock prices, right? That's not true. Economic growth is just the total value of transactions, like how much stuff is being sold. But stock prices, they are much more complicated. They're driven by earnings, return on capital, and what the market thinks will happen. Let's break it down. First, earnings per share, or EPS. This is basically the company's profits divided by the number of shares. More profits, more happy investors. Return on capital. This is how much bang a company gets for its buck. Big brands, service companies, and tech firms are usually champions at this. And market expectations. This is where things get fun. How people feel about the market matters a lot. In China, investors are a bit like roller coaster fans. The market is full of retail investors who think short term, which makes it more volatile than your weekend plans. The SOE dilemma. When big isn't always the best. China's stock market is dominated by state-owned enterprises, or the SOEs, companies that answer to the government. Their missions, for a long time, it was to grow big, not profitable. These giants are more about supporting the national policy than raking in cash. The fun fact is that in 2020, 38 listed state-owned banks made up 42% of the total earnings in the domestic Chinese market. Yep, nearly half of the pie. But are they efficient moneymakers? Not really. Plus, China's real estate sector operates like a high stakes game of monopoly. Developers sell homes before they're even built, making it more like a financial institution than a construction business. And most of the money, it flows back to the local governments and waits for banks. Does that sound familiar? The IPO drama and stock issuance. Unlike in the US, companies in China have to get government approval before going public. This keeps a lot of techs and biotech companies listing elsewhere, like in the US or Hong Kong. These firms are often risky but could become massive winners once they prove themselves. Imagine investing in the next big thing, but only if it can escape the regulatory cycles. Plus, Chinese companies have a habit of issuing more shares when they feel the share price is high rather than when they need cash, which dilute your stake and messes with shareholder value. Oh, and dividends? Forget it. SOEs aren't exactly generous when it comes to sharing profits with shareholders, at least not until recently. The silver lining. Change is coming. Okay, here's the good news. Things are changing. Dividends are on the rise, and SOEs are being pushed to focus more on profitability rather than just growing for growth sake. This could seriously lift the market in the long term. On top of that, private companies are the real innovators. And there's a growing recognition in the top government officials that they do a better job at pushing the envelope than the big state-owned giants. But before you get too excited, some of these changes might be temporary. Policies could flip-flop, and the mindset of the big players hasn't fully caught up yet. So, what should you do? If you're thinking about investing in China's stock market, here's the strategy. Don't rely on index funds like you might in the US. Focus on picking solid companies, the ones you believe in, or at least the trends you believe in. The Hong Kong market and US listed Chinese companies typically release more English language disclosure relative to domestic Asia listed ones. If you do not have much investment knowledge but want to invest in the index, look for two things. Number one, a sustained increase in the capital supply into the market towards the good businesses rather than the index, or companies which issue equity when they have no debt. What you want to see as an index investor is that the best and the fastest growth businesses are the biggest constituents of the index. Number two, a change in the types of companies that dominate the market. High return businesses taking over from old school industries like banks and utilities. Otherwise, stick to good old fashioned stock picking. Find those companies that stand out and avoid blindly following the herd. Investing in China's stock market can feel a bit like riding a roller coaster. There are ups, downs, and the occasional unexpected loop. But with the right mindset and strategy, it can also be incredibly rewarding. So if you're ready to dive into the world of Chinese stocks, keep your eyes open, do your research, and don't be afraid to take the plunge. Just maybe leave the index funds for now. Thank you very much for watching. See you in the next video. Bye.